In the words of the OJs, it is Friday, January 20th here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Jared Blickery, Julie Hyman, and Brian Sazi are making their way back from Davos. We've got three things, though, that you need to know as the clock hits 9 a.m. this morning. A brutal week for big tech. Google slashes 6% of its workforce in the largest round of layoffs in the company's history. This comes after a wave of layoffs earlier this week from Microsoft and Alphabet. We're going to discuss the future of the battered sector.
Plus, an unexpected ending. Reed Hastings steps down as CEO of Netflix, but will he remain as chairman? What do we know about the new co-CEO taking the helm, and what should investors do with the stock? We have all the answers coming up.
And let's get a check in on the markets. Futures this morning, they are mixed as the Dow is pointing lower right now, just fractionally by about 0.1%. S&P 500 and the Nasdaq, you're seeing both of those in positive territory, flat but to the upside for the S&P 500. And then additionally, the Nasdaq Composite right now, you're seeing that higher by about 0.5%. But we begin today with our top story. Google parent company Alphabet announced it's laying off 12,000 workers, or about 6% of its workforce, marking the company's largest ever job cuts. CEO Sundar Pichai said the tech giant expanded too quickly during the pandemic and now must refocus its business. Google joins a slew of big tech firms cutting jobs as the entire industry continues to struggle. And I really do think it comes down to that part of the statement and the memo to employees that he said over the past 2 years, they've seen periods of strong, dramatic growth. And to match and fuel that growth, they hired for a different economic reality than that they face today. And you'd been looking at some of the numbers to really point at how much some of these tech giants have hired.
It's pretty amazing, and we have some charts, maybe we can bring them up, just of, this is a total. This would take into consideration Amazon, Alphabet, Microsoft, Apple, Tesla, and you can see that graph is over the pandemic from the lower left to the upper right. Now, this only ends as of the third quarter, so this doesn't take into consideration what's happened over the last few months. We're going to see that as a lot of these tech companies report earnings over the following week or two, once they publish those numbers, you're going to see that probably tick down quite a bit, and we're going to be tracking that here. But let's go to the Wi-Fi Interactive. I just want to chart the Alphabet price action over the last 3 years. Here is the pandemic low early in 2020, and here is the high. And you can see the current price just about in the middle, although a little bit less than that. But let me show you what I was tweeting at Miles, our content editor here. And we have big tech headcount growth over the pandemic. And the biggest was Tesla, and that grew its headcount by over 100%. And that's from December 31st, 2019, so maybe a couple months early, again into the third quarter. Now, Meta and Amazon not far behind. They almost doubled their headcount. Alphabet over 50%, so is Microsoft. Apple was the steadiest, only grew it by about 20%, but you can see for the average or the total here, looking at about 45%. So huge numbers. We know that in 2021, after all the fiscal and monetary stimulus, what happened? All these companies overhired, and now they're dialing that back. And with that, there's going to be a great reshuffling. We have new ventures. A lot of these tech employees making lots of money. They're not going to be out of a job for long, as we've been discussing.
Within that even reshuffling, I think larger question too that a lot of companies are starting to answer either through their actions and announcing that they've got to reduce headcount or restructure their costs. A lot of that is around the normalization that's taking place too. And within that normalization for a company like Google or Alphabet, it goes to show within some of the investments that they have made, even though you do see this, even with, I should say, this pullback in advertising spend that's taking place at some companies. And then additionally, you're thinking about the cloud seat compression too, that could really hit Google or Alphabet on both sides there. I think at the end of the day, it does come back to what normalizations in spends for the companies that are customers, either on the advertising side or on the cloud side for Google, what that signals to them and the normalization of the headcount that's necessary to also support that existing client base. And so going out into the future, what that growth profile looks like for these companies is going to really be the question that I think a lot of analysts and investors out there point to say whether or not what was previously high growth internet names can actually retain that and lead the next bull rally whenever we do see that.
Yes, I like the term normalization because we are getting a normalization into the new norm. Because guess what? It's not going to be like the last 10 or 14 years with the new interest rate regime, with high inflation as we have here now. Got to move on and talk about Netflix, because Netflix co-founder Reed Hastings stepping out of the limelight, leaving his role as co-CEO of the company he's led for over 2 decades, handing it to current the COO, Greg Peters. Now, Greg Peters is going to join Ted Sarandos as co-CEO, and while Hastings will serve as the company's executive chairman, what does this mean for the company moving forward? Yahoo Finance's Ali Canal is on the case. And Ali, what's going on here?
Yeah, a bombshell executive shakeup. And the big question on investors' minds is, who is Greg Peters? What can he bring to this company? And I think it's important to understand how involved Peters has been on the product side of this business. He was very responsible for launching that ad-supported tier in November. He helped spearhead Netflix's push into gaming, and he also led the expansion of Netflix into Japan. So he's been involved with this company for well over a decade. On the earnings call, Reed Hastings did say that this has been a succession plan that has been in place for 10 years. And basically yesterday's announcement makes something that was unofficial official. So, we'll have to see how this goes moving forward. It's this changing of the guards, though, that we've really seen across tech, across media. If you think about some companies like Amazon, like Twitter, even Disney, weird situation with Bob Iger leaving the company and then returning. But even Bob Iger is searching for his next executive. And we seem to be entering phase 2, some would even argue phase 3 of the streaming wars. And because of that, there's a new emphasis on profitability, not as much of a focus on subscribers. And there might be other executives that are better suited for that phase. And regardless, investors don't really seem to care. The stock is up about 6% in the pre-market. And Jared, you pointed this out. If these pre-market gains hold, the stock will have more than doubled from its May 2021 lows. So positive sentiment on the street right now.
Even as you were mentioning Disney, it perhaps begs the question if Disney should move to a co-CEO strategy as well in the future. That's a different question for a different day. But as long as we're talking about Netflix, listening into the earnings call, it was interesting to see how much they're looking to monetize every single user and really crack down on even some of the password sharing. But notably here, I did want to play this clip from that earnings call when they were talking about when we can expect to see even more of the accounts that we were talking about yesterday on the advertising tier, when we can expect that to really show up even more so in that subscription growth as well.
I just want to emphasize it's a multi-year path. So we're not going to be larger than Hulu in year 1. But hopefully over the next several years, we can be at least as large, and we wouldn't be getting into this business, obviously, Reed, if it couldn't be a meaningful portion of our business.
So plain and simple, what is the outlook for Netflix subscription growth here?
Well, it's worth flagging that we're not going to have subscriber guidance from Netflix moving forward, since they have said that revenue is their top line metric. And you have to wonder how well this stock would have done if we were not provided with that sub guidance of 4.5 million. I think it would have been a lot harder for investors to contextualize how big of a beat this was on the subscriber side. So moving forward, I do think that Netflix will have to provide more specifics on the ad tier, more specifics on that password sharing crackdown. How are those efforts adding to incremental revenue, adding to subscriber gains? And on the earnings call, we did get a bit of color, not too much detail considering these initiatives just recently launched. But, we just heard in that soundbite that Netflix believes they can surpass Hulu's ad business in a few years. They want this to be bigger than at least 10% of its revenue. So that's really the focus here. That's what's important. That's what's driving the business. And Ted Sarandos did say that really this all leads back to content. If you have solid content, that's going to drive subscribers on both premium tiers as well as ad supported, and that's going to lead to profitability. So I think in 2023, we're going to see more heavy hitting content. They're still keeping up that $17 billion spend when it comes to content. And on the ad side, I think we're just going to need a little bit more specificity. If that's
Specificity.
Yeah,
I got it right.
Yeah, you did it the first time.
Yeah. But yeah, so I think that really is going to be number one for investors.
All right, number one for me right now is to finish Wednesday. I still have a little bit of work to do
Yes,
on
that's
that.
next on my list.
Yeah.
I'm chugging through Emily in Paris right now.
There you go. All right. That's gotten mixed reviews here in the newsroom, but we'll leave that conversation for later. Yahoo Finance's own Ali Canal, thanks for breaking down the numbers here with us, Ali, and the earnings call. Well, further here, Netflix subscriber numbers, they did blow past expectations. Analysts on Wall Street, they seem to be looking past its big EPS miss, with nearly half of the Wall Street consensus rating the stock a buy. Let's dive into the Netflix picture on the street with Macquarie senior media tech analyst Tim Nolan, who has a neutral rating on the stock, $285 price target. Tim, great to have you here with us this morning. Investors, I mean, if you hear that you're going to have a subscription number or at least guidance that's going to be pulled in the future, does that give you jitters at all?
Less now than it did before. They announced this already last quarter's call, that they would be foregoing giving subscription guidance. Now, subscriber number guidance. They will be giving those subscriber numbers when they report, but we won't get an outlook. And actually, I think it's the right move. I mean, you know, Netflix for a few years now has talked about wanting to be viewed more as for lack of a better term, a real company. I mean, this investor obsession with subscriber numbers for the last decade has run its course. And what matters really is revenue and earnings and free cash flow. And Netflix has been focusing on that a lot more over the last few years. Bear in mind, too, as they've introduced this advertising tier, and as they're moving toward getting rid of a lot of these free riders on these sharing plans, and introducing more alternatives to get more subscribers on via, for example, the ad tier, and then introducing the sort of sub account basis for an extra charge, you know, for paid sharing. That actually makes it more difficult to understand what the sub numbers are going to end up being. So I think they don't want to get caught out, you know, with these new complexities in the subscriber counts, when what really is going to matter is what are they going to be making off of these subscribers. So that's really where the focus for Netflix has been for the last few years, and certainly where investors are turning their attention more recently.
Tim, I got to ask you about Reed Hastings, kind of stepping down here, taking that executive chairman role. We've seen this with founders before. Just take a look at what happened with Salesforce, Mark Benioff. Hard to actually step down now. Do we have 3 CEOs here with Greg Peters? Just your I guess your 30,000-foot view on the situation. How do you think this is going to evolve? When do we finally get one CEO in this company and one decision maker?
Oh, I don't know. And I don't know if it matters so much. I mean, you know, we've had this co-CEO role between Reed Hastings and Ted Sarandos now for a couple of years, maybe 3 years or so. And Greg Peters has been on every earnings call for as long as I can remember, going back several years. And it's been quite clear when he was, especially given that COO role not long ago, that he was kind of next in line. So, you know, it's really been this kind of 3-person leadership team for quite some time. If Reed Hastings is executive chair, well, that title executive on top of the chairman, you know, implies that he's certainly very much actively involved in guiding the company. Mm-hmm. And then Ted Sarandos and Greg Peters have been, like I said, around for a long, long time doing what they've already been doing. You know, it seems to be just kind of a next formal phase in what's actually been going on for some time. So I don't really anticipate much of a difference here.
Okay, take us further into your price target here. And I want to make sure that we had this correct. I think I mentioned at the top $285. You've actually recently raised that to $350. Yep. Catalysts behind that? Yep.
Well, we raised our target from 285 to 350 on last night's numbers, basically. So the quarter that they reported was better than expected. Now, always bear in mind, it's very, very difficult for anyone outside of Netflix to really know what's going on with subscriber trends, with ARPU trends that drive their revenue. So, you know, we, along with the street, basically has to rely on their guidance figures. Their guidance for Q4 was to add 4.5 million subscribers globally. They added 7.7 million. Their guidance was very modest revenue growth of 1%. They grew 2% in the quarter. And operating income also beat their guidance. So that was positive. And then going into 2023, again, there's a lot of complexities with the paid sharing plans that are coming out and the advertising tier that will affect subscribers and revenue and earnings growth. But their outlook statement basically talks to operating income coming in higher than they had previously guided to by about 200 basis points. So operating margin being in the 18 to 20% range. And remember, look at like a Disney Plus or Warner Brothers Discovery. They're all deeply negative on their direct-to-consumer businesses in terms of operating earnings right now. Netflix is looking to 18 to 20%. So that was an upgrade essentially. And then also very importantly, free cash flow, which was negative for years and years and years. But fortunately for Netflix at the time, didn't matter then. Now matters a lot. They hit 1.6 billion of free cash flow in 2022, and they're guiding to 3 billion in 2023. So these are much larger numbers looking into 2023. The stock is trading about 20 times EV to EBITDA. We've raised our estimates. So the new target is based on a similar multiple, around 20 times on those higher numbers. That's what gets us to 350. I think there's some momentum in this one for now. I think looking at some of the peers that, will be reporting, and I hope in some cases will be evidencing some better operating margin performance going forward. But Netflix is still very far ahead of those. And so I think, with the momentum, with the rising numbers, I think that justifies the 350 target for now.
And that's let me ask you that, because I'm looking at the Wi-Fi Interactive here. I got a chart of Netflix over the last 5 years, had a little oops here, kind of dip below what could be potential support here, but we're 100% off of that low here. And you mentioned 350, that's maybe right up here as a target. Is that over the next 12 months? Any kind of reticence you might have into taking the plunge right now if you're not already in the name?
Yeah, well, also bear in mind, 350 would be 50% downside, I believe, from the stock's all-time peak at one point post-COVID. So there's still a long way to go to get back to where it was in the best of times. But of course, look, I'm always considering, what should my rating be on a stock, what target price to use, and how does the target price affect the rating. What we were working through as we were going through the numbers and the sentiment on this last night was, I'm still not quite ready to go full out bullish on Netflix. Look, my tilt is positive. I like the company. I like what they're doing. I like the strategic moves. The valuation, versus any other peer you might look at, certainly in the media space, is extremely high versus other internet tech names, is in there. It's not cheap versus really anything, I don't think. But, what keeps me really on the sidelines and not getting more bullish on the stock is how the year will play out in terms of the phasing of growth. Netflix seems to be quite optimistic that their paid sharing program will add incremental subscribers. They've tested this in Latin America. I'm not gonna doubt their experience there.
Sure.
But what they're saying is there will be some churn in the near term. And just think about it. If you have, your college age kids and your cousin riding on your Netflix subscription now, and you basically get told that you have to either pay $3 more per month to add them, or they get shut off, what's going to happen? You might say, well, I'm not really watching Netflix, I'm just going to let it go. Or they say, what Netflix says is going to happen is people will get cut off, and then they're going to come back on as new subscribers when they realize what they're missing.
Yeah.
We'll see what happens, but the near term is potential churn before you get some subscriber ads. So, I'd rather kind of wait and see how that plays out.
Tim, we got to leave things there for the day. Certainly do appreciate the insight, the analysis here this morning, fresh off of the earnings yesterday evening. Macquarie Senior Media Tech Analyst Tim Nolan, thanks so much for joining us.
Thank you.
Coming up, longer for longer appears to be the name of the game for the Fed's monetary policy strategy. We're going to dive into some Fed expectations next.
You never can time the bottom of the market exquisitely well or the top. But you should basically say, look, the economy has some problems. People are pulling money out of the market. That makes it cheaper, and therefore it's time to get in. So I think it's actually a good time to invest.
That was Carlyle Group co-founder David Rubenstein earlier this week at the World Economic Forum with some encouraging words for investors looking to get into the markets. But what can investors expect once they step foot into the volatile trading environment? We have PNC Asset Management Group Chief Investment Officer Amanda Agati here to discuss. Amanda, always a pleasure to speak with you and grab some of your time. You've said that longer for longer appears to be the name of the game for the Fed's monetary policy strategy. You pair that with the comments you just heard from Rubenstein. How is an investor to make their decision about when to jump in, perhaps when to time their investment, given the Fed's policy and what you're eyeing up here?
Well, thanks so much for having me. It's always great to be with you. It's a doozy of a question to start things off here. In general, we're not big fans of trying to time market moves. And so a more systematic approach to allocating new capital into the markets feels right, especially given the perfect storm of macro headwinds that continues to swirl and really this high volatility regime that continues to dominate the backdrop. With the Fed firmly in the driver's seat here, we're going to continue to see some choppiness despite this kind of optimistic short-term rally we've had to start the year. The Fed is nowhere near done. The Fed definitely has much more to do, and that's why I keep saying it's sort of a longer for longer dynamic here. More rate hikes to come, obviously, potentially a higher terminal rate and a longer overall sustained tightening cycle. So with those being the big drivers in terms of the outlook, the backdrop, financial conditions, I think it's going to be choppy waters for investors, but that doesn't mean that we shouldn't be actively invested in markets here.
Well, Amanda, I'm just looking at your notes here. You've expressed some doubts about perhaps a soft landing that may not come, at least not immediately, and may never come in this cycle. But you're saying that we have potentially another 10 to 15% downside. So in that potential environment where we have indices leading down, what are you looking for in maybe individual stocks, ETF style sectors, anything? What's grabbing your attention now?
Well, I think for right now, we're still playing defense with the idea that we might have some more significant price declines ahead. You have to be playing a little bit of defense. So in general, we're positioned more towards favorability around U.S. over international, larger over smaller capitalization, and a bit more value oriented than growth, although that bet can kind of go a little bit either way. So not strongly tilting into value. But I think what's interesting in this environment is investors don't have to push too far out the risk curve like they have in prior years, given where interest rates are moving to. So on the fixed income side, we're not feeling quite as ambitious in terms of moving into below investment grade credit. We still think there are opportunities in investment grade here.
Amanda, do you believe that this will be the quarter for earnings season where companies will finally start to be clear, transparent, perhaps rip the Band-Aid off about what the earnings expectations actually should be for the year, and perhaps lead us to a less optimistic environment where we can kind of set real expectations for how they may perform, and then the markets may pick up off of that?
Oh, absolutely. We think the earnings recession clock starts to tick with Q4 earnings season. We did see some pretty significant negative revisions coming into Q4 earnings season, but nowhere near enough. Consensus is still too optimistic, given the potential for us to move into a recession as early as Q2. So when we just look at simple peak to trough kind of analyses over past economic cycles, even in a mild recessionary scenario, you'd expect earnings growth to fall about 10%. We're only about 3-4% off of the peak expectation. So there's definitely some more downside to go here. But I think at the end of the day, it really is all about the Fed. And so if the Fed kind of follows the course that they have signaled and the terminal rate kind of hangs in where it is with the current dot plot, I think that mild recessionary scenario and sort of the framing we've given around 10 to 15% downside makes sense. But if they do have to go further, aka higher, I think that's going to create a much choppier, much tougher pressure for market returns this year, at least in the first half. When we get a better line of sight to where that end state for monetary policy is, I think the market will start to anticipate that and potentially rally. But I think it's going to be a tough first half.
Yeah, got to agree with you about the Fed, all about the Fed, watching very carefully here. Thank you as always. Great to see you. Amanda Agati, PNC Asset Management Group Chief Investment Officer. Coming up, retail in focus as department store sales took a big hit in December. We're going to get into some trending tickers as we await the opening bell.
Welcome back, everyone. As we await today's opening bell, let's take a look at the futures here. We were mixed earlier in the 9 a.m. hour, but as of right now, we're seeing green across the screen. The Dow up fractionally by about 0.1, 0.2% will be generous and round that up to. S&P 500 also seeing gains of about 0.4%, and the Nasdaq futures seeing the green by about 0.7%. So the trifecta, we'll see if we can hold on to that going into the opening cross. But Jared, there's been a lot to really kind of take away from this week. Everything from World Economic Forum, what we've heard from some of the leading business CEOs and profiles speaking about everything from recession to some of the headcount and restructuring costs that their companies have been employing, but also at the same time, just the environment for deals that they're trying to drum up too. Our own Brian Sozzi and Julie Hyman were out there having some of those conversations. That plus some of the Fed speak that we got as well. And our own Jen Schonberger was writing about this, but also speaking with us about it yesterday, just where we're anticipating perhaps some slower paces of rate hikes this year and when that could actually play out as well. Market's certainly latching onto that too.
Yes, and let's take a look. Looks like we only got a few seconds to the opening bell here, and we're going to be joining that in just a second. So why don't we just take a look at where the markets are opening today.
And there's a live look at the New York Stock Exchange, where City Harvest is ringing the opening bell, both virtually and in person. There you're seeing it all full screen on your screen. And as we kick things off on this Friday, January 20th trading session, let's take a look at the major averages here, as we were seeing a lot of green for the Nasdaq, the S&P 500, and the Dow Jones Industrial Average coming into the start of the session here. And that's exactly what you're seeing coming into the early moments of trade here on the day. The Dow flat to the upside, S&P 500 fractional gains there, as well as for the Nasdaq Composite. Let's get on over to Jared Blickery, who's over at the Yahoo Finance Interactive. Jared.
Well, we see some green on the board today, but that has not been the case for most of the week. And let's take a look at the Dow, which is just barely above the unchanged line right now. You can see it's down about 3.6% over the last 4 days. Let me just show you a year to date. You can see now it is actually negative on the year, so having given back all of those gains. Now, let's take a look at the Nasdaq. This is year to date, so it's holding on to 4%, and you can see that's more than half of what it's lost here. But let me just show you what it's done over the last 4 days, and you can see well off the highs, down 1.5% for the week. S&P 500 and the Russell 2000 somewhere in between. Want to get to the sector action today, and we are seeing communication services that is in the lead. Guess who's in that? Netflix, as well as Meta, Verizon, Disney, a bunch of others. Tech also doing well. That's up 1/3%. Financials, all of those outperforming the S&P 500. To the downside, we got energy, real estate, and utilities. Those are the only sectors in the red. And let me just take a look at what has happened over the last 4 days. You can see nothing in the green. Energy almost there, but still down less than 1%. Industrials took the biggest hit this week, followed by utilities, staples, financials, and materials. All of those in deep red territory. All of those down more than 3%. And let's take a look at the leaders index. This is going to be what's happened this week. Bitcoin, that's in the #1 spot. Maybe we can take a look at that later. Home builders actually took the biggest hit, followed by cannabis, retail, regional banks, and retail stocks. So really interesting week to see how we've given back a lot of these gains that we had built up prior in the year.
Great review of the opening bell here, Jared. I'm going to call you back over to the desk in a hot second here because we got to talk about this next story. Nordstrom in the red after the company announced that the 2022 holiday season sales were down 3.5% year over year. The retailer also slashed full year EPS guidance from $2.30 to $2.60. That was the range previously. It's now down at $1.50 to $1.70 here. And so, you kind of look through what the company had said in tandem with this. Net sales decreased actually 1.7%. Nordstrom Rack, that decreased 7.6%. And they said that the holiday season was highly promotional. Sales as well, softer than pre-pandemic levels. And they're continuing to say at least that there's greater resilience in their higher income cohorts. But consumers are being more selective with their spending, given the broader macro environment as well. That's quite the acknowledgement from the company.
Yes, and it's an acknowledgement that's being echoed and reverberating through the analyst community. I got some notes here from the street, and let me just begin with Bloomberg Intelligence. Nordstrom's pre-announcement that it missed on 2022 adjusted EBIT margin due to bigger markdowns. It just shows the need to up its game. It needs to up its game against Macy's and some of the other retailers. Now here's Jefferies. They hold the stock with a buy, recommended with a buy. Price target cut to $22 from $24. And they say while Nordstrom's profit reduction for the fourth quarter is, quote, disappointing, is based on temporary factors. And they're also noting that promotions weighed on margins. This is a very common theme that we heard over the holiday season. And we're probably going to hear a lot more of this as retailers report. This is a pre-report here. Also, this is Jeffrey saying investors should focus on Nordstrom's better inventory position. And I think that's going to be key for a lot of retailers, which is important for driving sales and margin performance in 2023. So all in all here, I think last year I talked about quite a bit about the bifurcated market in retail and how electronic retailers had fallen behind over the last 2 months. Well, that's it looks like that slump is over and we're in this new phase here. And when you get down to the brick and mortar shops, if they haven't figured out how they're going to compete in this new environment and they haven't gotten their execution down pat, then they're probably going to be left in the dust, because I see this a more challenging year, perhaps at least equally challenging as last year.
Well, this just adds to some of the guidance that we had received ahead of the ICR conference. So you'd seen that come in from Macy's and updating some of the expectations there. And you're seeing Macy's move lower here during today's session by about 0.7%. And then additionally, we had seen even some of the guidance revisions from Lululemon and guiding for lower margins. And so with that in mind, even among some of the higher income cohorts of the consumer out there, they are signaling that there's more of a value kind of determination that they're making with every single purchase to figure out exactly whether or not it's going to be beneficial, or you need to get, that another pair of ABC pants from Lululemon, or if you need to get something from, I don't know, Nordstrom at this point in time. But it really does point back to some of the data that we had seen come out earlier this week as well within some of the department stores data. The department stores were actually the biggest decliner in the retail sales month over month led the declines. It was down by about 6.6% from November of 2022. And so that really kind of giving us that tee up to now what we're seeing show up in some of the revised guidance from companies including Macy's, Lululemon as mentioned, and now today Nordstrom as well. Let's also talk about one company, Wayfair, that is laying off today. Layoffs continue to pile up as Wayfair is the latest to announce that they are cutting staff. The home furnishing company is set to let go of over 1,700 employees. That's roughly 10% of its workforce, including 18% of corporate employees, as it looks to eliminate some levels of management. This is all coming as part of a cost-cutting plan for the company, and they're looking to save, it seems, or within this plan, they're expecting that this will kind of remediate for themselves about $750 million a year from the job cuts. This includes cash plus stock-based compensation as well. The total plan is looking to kind of save about $1.4 billion in costs a year as well.
Yeah, I think it just kind of continues a story that we've been talking about, well, not only for months, but also since the beginning of the show, because we led with the Alphabet story, cutting, 10,000 employees. It's just going to continue here. And as we've been saying, these are tech employees. This doesn't necessarily bleed into the economy, but got to keep that in mind. Moving on to, guess what? Elon Musk continues to make headlines as the Tesla CEO may have bended some of the SEC rules. Musk sold nearly 22 million shares of Tesla prior to the company reporting fourth quarter delivery numbers that came in weaker than expected. Now, the timing of Musk's stock sales certainly raises some questions. Brad.
Yeah, it does, but it's also what needs to be proven if the SEC does decide to look into this as well, because at the end of the day, any type of insider trading allegation or a charge that would come forward, there's proof of communication that needs to be proven there. And so that proof of communication and the time correlation of that communication is what's key if there was to be any investigation that does get triggered. But it is a critical question as to what the original intent of his sales of that stock was. We know it largely kind of in public to be time correlated to when he was trying to finance the deal for Twitter. Right. But there is the larger question of what he already knew about the company and Tesla and some of the operations there and the health of the company that I think the SEC, if anybody over there is reading the story this morning, they may be interested in.
No comment there. We've seen this story. It's Elon. Yeah. He might get a slap on the wrist.
Right.
I don't see much happening.
We saw a similar story at the beginning of 2022 as well. Yes. I believe February 2022. He and his brother Kimball Musk.
He's got a heavy trigger finger, a heavy tweet finger, and now he's the CEO. Square that. Yeah, SEC. We'll see.
Coming up, everyone, fast food in focus. We're going to preview what to expect as earnings season is set to hit the drive-through lane. Stay tuned. Earnings season is in full swing, and over the next few weeks, we're going to be hearing from the biggest fast food companies. Yahoo Finance's Brooke DePalma joins us now to tell us what the word on Wall Street is ahead of some of those reports. Brooke, what do we know?
That's right. Well, inflation is certainly a hot topic for the beginning of 2023, particularly on labor and commodities, in addition to that impact of inflation on unit growth. So first, wage over the past year in 2022 in total was up by 4.6%. That's average hourly pay. Now analysts expecting a gradual improvement. They say that 90-day turnover has been improving, as well as that starting wage for new employees has stopped going up. In addition, while not likely to be mentioned in the earnings call, Starbucks stores have been filing for unionization representation on a decrease there in just the amount of stores that are filing for union representation there. So another labor impact story to look out for this earnings season. Food inflation alongside labor inflation also taking a toll. We've seen higher costs on eggs and vegetables, dairy, pork, and poultry seeing a deceleration, but not necessarily a decrease, certainly weighing on companies' margins there. But really the big story here, as we move past COVID-19 era permit delays, as well as supply chain strain that really took a toll on unit growth, you can expect company-owned stores to really see a robust plans for unit growth. In particular, Shake Shack gave us some preliminary Q4 results at the ICR conference. As you can see here, they plan to open 65 to 70 locations in 2023 with big plans for licensed businesses in Asia overseas. Of course, COVID in the background, still a very prominent in Asia as far as expansion goes. But as far as franchise-owned stores, of course, that's companies like McDonald's and Yum Brands, you can expect to see less growth there. At least that's what analysts are saying, as the impact of inflation and labor and just higher costs overall continue to impact franchise operators. And they say that right now margins are just a bit too tight to eye further growth. But for company-owned stores like Starbucks and other stores like Chipotle, Shake Shack here in the U.S., they could really withstand those major headwinds, and they're planning to expand this year.
Brooke, we got to leave it there, but great information here. Thank you for that report, Brooke DePalma. Coming up, we head out to Davos as Julie Hyman caught up with S&P Global CEO and President Doug Peterson for his outlook on the global economy. Stay tuned. Welcome back. Big data doesn't come much bigger than S&P Global. From ratings to indices, market analysis, it's been a leading player in the space for decades. Now it's even bigger. As for giant mergers, there aren't too many more notable than its $140 billion tie-up with IHS Markit. That deal completed early last year. Yahoo Finance's Julie Hyman caught up with the group's CEO and president, Doug Peterson. She asked about the integration of the companies and the general tone of the World Economic Forum.
We do see a slowdown in the EU, in the UK, and the US. Could be dipping into a mild recession, recovery later this year. We don't quite know the timing, but how do you prepare? It depends a little bit on your industry and your business. What I'm finding a consensus here, a lot of companies that I've been meeting with are slowing down their investments and their hiring in the first quarter. They want to see what the conditions are going to be like, what kind of growth we're going to have. And so we see a few that are doing layoffs and really lowering their cost base, but most are just cautiously slowing down.
Gotcha. You know, you've been coming to Davos for a long time with a few breaks here and there, and you know that the global perception of this meeting is not entirely positive, safe to say. As someone who's come here for a long time, what would you say to that, and how has the meeting changed as you've been coming?
Well, first of all, one of the benefits is that you get the entire globe here. You get academics, you get people from research areas, you get business, financial services, you get government. So you get the whole aspects of the economy here, and you can have really open dialogues. I'm finding that we're talking a lot here about sustainability, about energy transition, about economic growth. And so these are the themes that have been consistent throughout. Maybe this point about sustainability wasn't something we were talking about 10 or 11 years ago. Then we were talking about the financial crisis, post-financial crisis recovery. So maybe we've kind of evolved away from that into some new topics, but it's always been about the global economic.
Right. And what about the idea of how people get here when we talk about sustainability, right? How do you think about that?
Well, you mean
in terms of flying in?
Oh, flying in. Well, everybody is obviously looking at their own footprints, their environmental footprints for their company or for their organization. I actually have heard some people that flew in this year commercially instead of privately. I fly commercially when I'm flying internationally, and it's something that people are very conscious of now and becoming much more so.
Right, because they know a lot of attention is on it. I want to talk about your company a little bit because we haven't talked in a while. You were busy digesting a big acquisition of IHS Markit, $48 billion acquisition, and it's changed the company, right? I was looking at the revenue breakdown actually and how it sort of shifted, now weighted more towards market intelligence, weighted less towards the rating business, although obviously that's still important. What do you want to communicate to people about the new S&P?
Well, the new S&P has a strategy, we call it Powering Global Markets. And we have all of these different divisions that are providing independent, transparent information, data, benchmarks, indices that allow investors to make informed decisions. And what we have now with the two companies coming together is much deeper information, much deeper data. We're able to invest in technology, machine learning, artificial intelligence in a way that's at scale. And you are using us already. I know you are. You might not know it.
Yes, we definitely are.
But everyone is using our data to make decisions and to understand what's happening in the markets. And for us, it's really exciting to have all of these new capabilities. And you didn't mention commodity insights. We now have a very large position in information and data about commodities. And this goes, right now it's very relevant what's happening in the world with energy, with agriculture. And so we have all of these different markets covered: debt, equity, commodities.
Let's talk about commodities for a second. And I know you're not, deeply steeped in the day-to-day data crunching on that, but that's been one of the topics of conversation that we have had with people here, especially because obviously inflation is top of mind. We've talked to some folks who say we're going to see a big reacceleration in commodity prices this year. Is that what you're seeing?
Well, it's possible and probably driven by China. We know that China was in a zero COVID environment for the last few years, which meant that there wasn't a lot of consumption. And that creates two, let's call them opportunities. One is that there is a lot of pent-up capital which could be going into the investment world. They believe there's about $2 trillion of new savings in China that could go out to the markets for investing. And then as consumption increases, there could be increased demand for soybeans and iron ore and the pull of commodities around the world, and that could increase prices.
Speaking of China, Vice Premier Liu He was here, which was a bit of a surprise. Do you think that it's positive that he was here? Do you think that it sounds like you don't think Chinese growth will slow to the extent that it will maybe harm the rest of the globe. What do you think?
It was down to about 3%. It should increase up to 4.8 or so this year, could be even be higher. I think that having the Chinese here was very positive. If you remember the last few years, there hasn't been a lot of face-to-face dialogue, probably on Zoom calls and things like that, but getting the Chinese engaged, having the dialogue again, some of the words that were used were very positive. They talked about engaging with the world. We're seeing that there's obviously an understanding that China is very engaged and involved in the global supply chain, and their largest customers are here in Europe and in the US, and I was very, very, very optimistic having them here.
That's great. And finally, to circle back around to the acquisition for a second, because it's almost a year now. I believe it was late February when you closed the acquisition last year. And you've done some sort of divestitures and tinkering around the edges. Is it pretty much done now, the integration? And are there any other sort of deals around the margins that you're going to be doing in the coming years, or
well,
you're taking a little rest?
This is our priority.
Right.
When you're doing it, when you do a merger like this, it's so large, you have to make sure you get it right. And we started very quickly out of the box as soon as we announced the merger, even before we closed. We had an organization design in place, we had a strategy in place, and very importantly, values. We wanted to start with the kind of culture we wanted, and that's gone incredibly well. And then we could move quickly on what it had to do with our customers, with commercial operations. We're ahead of our synergies, both on the cost side and on the revenue side. And encouragingly, our customers are very interested and excited about what we're doing because we can bring data together in new ways that they can use. We're ahead of our sales synergies, so we're very pleased with this, but this is right now our focus. We're very interested in commodities and indices and fixed income markets, so it doesn't mean we're never going to do acquisitions again, but right now our main focus is getting this done right.
And just very quickly, are you seeing any kind of slowdown in demand from your clients as we see this economic slowdown?
Well, we did see that there were almost no M&A acquisitions deals last year, which meant that we didn't see a lot of volume for some of our ratings areas, for some of the data products that we have that rely on IPOs. So we did see some slowdown, but our basic subscription businesses were motoring along quite well. And there's a lot of interest in what we do in a market like this because we're a voice that's gathering information from all over the globe, from all different sectors and industries. We have risk businesses. People want to know what are the risks. They want to know what the trends are, what the forecasts are. So sometimes in a tough market, people actually come to us even more.
That was S&P Global CEO and President Doug Peterson alongside Yahoo Finance's Julie Hyman at the World Economic Forum in Davos. More from our team later on. Coming up, check yourself before you wreck yourself. Good news on the longevity of COVID-19 vaccines on the 3-year anniversary of the first case in the U.S. We get into that and more next. It was 3 years ago that the first COVID-19 case was diagnosed in the United States. But this morning comes with some positive data. A new study showing COVID-19 vaccines offer protection against long COVID. Yahoo Finance's Anjali Kamlani has the details on this one. Anj?
That's right. 3 years ago, the first positive case from a man in Washington state. But now here we are entering year 4, and we still haven't learned absolutely everything we need to know about COVID and long COVID. But new study out showing that there is protection up to 41% of a reduced risk of long COVID for anyone who gets vaccinated after being infected. That's coming out in a new report in JAMA, and showing that there is some long-term benefits for these vaccines. Now, we know that there has been a lot of discussion about the vaccines and their drop in antibody levels several months after being injected, but at least we know now that there is some hope for those long COVID sufferers. There is something in these vaccines to help protect long term, and that's really good news because we know we're still learning about how to deal with long COVID as well.
Yes, we are, and a lot to learn here. Thank you for that report, Anjali Kamlani. Coming up, we have some breaking econ data to get to as existing home sales numbers set to cross on the other side of the break. Stay tuned.
Welcome back to Yahoo Finance Live. I'm Brad Smith with Jared Blickery. Let's check in on the markets this morning as we are continuing to track some economic data that's coming in, and markets right now are mixed. The Dow lower by about 0.2%, S&P 500 higher by about 0.2%, and the Nasdaq Composite, that's higher by about 0.7%. We want to bring you some breaking news on the housing front, though, as existing home sales are coming in. And Jared, you've already been able to take a look at some of these numbers here, but it's seeming like we're seeing a significant decline here out of the gate here on the existing home sales numbers that have just dropped.
Yeah, let me just get some of the details here. And first of all, we're seeing that the existing home sales 4.02 million versus estimates of 3.95 million. That is actually better than expected, but it's 11th consecutive decline and the lowest since November 2010. And that's according to the National Association of Realtors. Got some other stats for you. It looks like the sales totaled 5.03 million units in 2022. This is down 17.8% from 2021. So when you look at some of these comps, pretty big and steep declines here. Median home price rose 2.3% from last year to $366,900. And when you take into consideration that mortgage rates have basically doubled over the last year and new home prices continue to go and march northwards, what is that doing for the average person who wants to buy a home? I think a lot of investors are locked out right now. We might see some of these numbers stall until we see people who are in the market for a house better able to afford them with either more cash or more favorable terms and interest rates.
Yeah.
Or lower prices.
Yeah,
that's it.
Exactly. And our viewers are seeing there on the screen the actual that just came out. December existing home sales down 1.5%. What's notable to me here is also the inventory. The inventory fell to 0.97 million homes from a month ago. And what's particularly notable about that, and it comes back to something that you were mentioning, is sellers clearly waiting to put more inventory on the market as well, knowing that the buyers right now are still waiting for some of the more favorable terms to come into fruition here. And so that, as we're seeing the number of buyers, first-time buyers, 31% of all total sales are first-time buyers here, and 28% of all the buyers were all cash here. And so within this kind of complex and dynamic, it's going to be interesting to see exactly where some of the people who are listing or the homes that are waiting to list are also going to wait for more buyers to just feel confident in their financing terms too.
If I have a 3% mortgage right now and my home price is still going up, why am I going to sell unless I absolutely have to?
Right. Absolutely. All right, guys, shifting gears here. Airlines, they are forecasting continued strong demand even after operations were tested during the quarter, accounting for holiday travel. Cowen is naming United Airlines its best idea for 2023. For more on the steel bird trade, let's bring in Cowen's senior research analyst, Helene Becker. Helene, great to speak with you this morning here. Why United Airlines as the best idea for 2023?
Hi, thanks for having me. Well, our number one reason is international business expansion. So we think domestic business travel will not grow that much this year. You're seeing a lot of layoffs at companies, especially on the West Coast, where United has one of its major hubs. But you are seeing a return of international business travel, where it's just so hard to do Zoom calls with time zone changes that range from anywhere from, say, 7 hours to Eastern Europe from the U.S. East Coast to as long as 12 hours to Tokyo or 14 or 15 hours to Australia. So when you think about that, when you think about getting business done and borders reopening, United is very well positioned from their coastal hubs to encompass that travel. And they're also adding more leisure destinations for the summer to encapsulate that. So from our perspective, we think they're in a really good position to grow that business. That's higher margin, higher yielding business. Airfares in the back of the cabin are going up or have gone up and don't seem to show any signs of abating. And their costs, even though we expect their labor costs, especially pilot costs, to rise in the second half of this year, their costs seem to be somewhat under control.
And let me ask you about some of the competitors then. Delta, another big airline here that you cover. How does Delta compare it to United and some of the favorable terms that you were seeing in that particular airline? How does that cross over?
Yeah, so sort of similar. The only difference between United and Delta in here is that Delta has some very cost-specific issues for the first quarter. So for them, they have higher maintenance costs than United has this quarter. They have a shift in, or an increase, I guess I want to say an increase in capacity from their core hubs like Atlanta and Minneapolis, and that shift is going to cause their unit costs to appear to rise faster than those of United's, or maybe go down slower than those of United's, because they're both forecasting a decline in unit costs this year from the 2019 I guess the 2019 levels, kind of getting back to those levels. Anyway, I think those are some of the issues we see for Delta that are very company specific that we don't see for United. But that said, Delta has a great balance sheet. They're paying down debt. They're not buying $20 billion worth of aircraft this year and next year combined. As United is, they have the commitment to pay down debt before they return capital to shareholders. So we do have an outperform rating on Delta too.
Helene, all of the airlines are still trying to get back to their pre-pandemic capacity, and all of them are pointing to pilots as well. United Airlines making a big investment in one of its new hubs to train pilots and even some of the flight attendants. We know that this has been a big priority over at Delta from our conversations with CEO Ed Bastian as well. Do pilots eliminate all of the capacity issues, though, that airlines have right now? And what is the difference that customers can expect once pilots are fully back in the throes to those pre-pandemic levels?
Okay, so that's a fair question, and there's a lot to unpack there. Here's my thought on this. In 2020, the airlines asked any pilot who was intending to retire between 2020 and 2022 to accelerate their retirement, compensated them by paying them until whichever day it was that they were going to turn 65. They kept them on for health benefits and so on. United didn't do that. They just asked their pilots if they would consider cutting the hours for all pilots rather than accelerate retirements. Probably some pilots did retire, but they tried to keep as many on staff as possible. Now, as you think about coming out of the pandemic, the industry had to hire 10,000 pilots to replace the ones that retired in 2020, those that were accelerating retirement and those who were mandated to retire anyway. And now, fast forward to where we are in 2023, the industry had to hire something like 14,000 pilots last year to replace those who left and those who were turning 65 anyway. And then as you think about the growth this year, this was going to be a peak decade anyway. We wrote about this as far back as 2014, that the 2020s were going to be a period of time when the airline industry needed to accelerate pilot hiring. And this year we're forecasting at least 10 to 12,000 pilots need to be hired. 8,000 at American, Delta, United, and Southwest alone, and then the other 2,000 to 4,000 at every other airline to handle the growth. This is why many small cities are losing service, because airlines are hiring from their regional partners. And just because one airline says we won't hire from this regional partner because we don't want to, screw up our own feed, it doesn't mean another airline won't hire from them. So you see a lot of pilot training going on. That's a big bottleneck. We're thinking that doesn't get resolved before next year at the earliest, and more likely 2025. Every time I think about how close we are to 24 and 25, it's astonishing to me because it's going to be a couple of more years. And then aside from all of that, you don't have a lot of expansion going on at airports around the country. Yeah. You have a lack of air traffic controllers, which people forget about and don't talk about. The government says ATC is not an issue, but the industry is losing 400 to 500 a year in retirements, and at least 200 to 300 a year wash out of the academy, and they only take 1,000 into the academy. So they're only netting 500 or so. So in addition to
Helene?
The pilot shortage. Yes, sir.
Yeah, I got to be quick here. We only got about 15 seconds. But if I'm an investor trying to figure out if I should get into any of the airlines right now, should I be excited or should I kind of be a little concerned about the number of pilots that need to come into the fold here?
I think you should be excited to invest in the largest airlines because they're never going to have a problem.
All right.
All right, we're going to have to leave it there. Really appreciate you stopping by. All your insights, as always. Cowen Senior Research Analyst Helene Becker. A judge is weighing today whether legal and other counsel for crypto exchange FTX carry any conflicts of interest in the bankruptcy proceedings, with most of the focus now on white shoe law firm Sullivan & Cromwell. Here to break it all down is Yahoo Finance's David Hollerith. David, what's the deal here?
Jared, the hearing has started right now. And today's, there's going to be several topics that will be mentioned, but one that has become front and center has been the issue of conflict of interest between all of FTX's advisors, but specifically the one that's taken the most focus is with Sullivan and Cromwell. Now, what's previously known before FTX filed for bankruptcy, Sullivan and Cromwell did perform legal services for FTX, and those were mostly related to transactions. The case's U.S. trustee has also previously raised concerns about the potential conflict of interest, and this has also been echoed by several U.S. senators and a few creditors also. And under new management, FTX has actually expressed support for Sullivan and Cromwell and said that they've been instrumental to securing and recovering the assets in bankruptcy, and that to eliminate the law firm from their services would slow the bankruptcy process now. But what's really changed things is yesterday afternoon, there was a court declaration that was filed by Daniel Friedberg, who served as FTX US's chief compliance officer and its chief regulatory officer for the international section. And in that document, Friedberg lays out a story about FTX and Sullivan and Cromwell that sort of pivots around Ryan Miller, who is a former Sullivan and Cromwell partner and became FTX US's general counsel and has stayed on since bankruptcy. The claims range widely, and in general, if they're true, it doesn't look good. Just one example is Friedberg alleges that Miller had told him while they both worked for FTX that his goal was to funnel FTX's legal business to Sullivan and Cromwell. Sort of what goes on from there is a story about the relationship between the two companies and how Sullivan and Cromwell has benefited from certain things happening at FTX. And this has been echoed also by the former founder, Sam Bankman-Fried. And obviously, he's been facing fraud charges. So there's been questions around that. But obviously, this declaration is a bit more serious, and it will be weighed. Now, ultimately, for a conflict of interest to be decided, the judge needs to find an example of evidence. And this testimony that's been delivered yesterday will be sort of the beginning of, I guess, what will be established in terms of what to expect as far as evidence goes.
Yeah, really interesting. Now that everybody's turned on SBF, I think Dan Friedman and his words when he's deposed is going to be really interesting here. Thank you for that, David Hollerith. And coming up, we get down to business as JP Morgan Chase CEO Jamie Dimon receiving a pretty nice compensation for 2022. We're going to break that down and more now.
Welcome back. Among the top stories that we're following for you today, JP Morgan Chase CEO Jamie Dimon receiving a cool $34.5 million for his 2022 compensation. Things look even brighter for the House of Diamond. The executive is slated to earn a $50 million retention bonus if he remains at the helm of the bank for several more years. That retention bonus, however, sparking some pushback from investors, including last year's investor vote to reject Dimon's pay and criticism as Dimon warns of an uncertain future landscape overall for Chase. The crypto winter continues with lender Genesis calling it quits, that company filing for bankruptcy after taking blows from the fall of both FTX and Three Arrows Capital. The company could be on the hook for up to $11 billion in liabilities. Reports saying this, and they also owe over $3.5 billion to its top 50 creditors. This is according to the filing. And Live Golf Tour, or LIV, depending upon what neighborhood you find yourself in, now headed to TV. This after a deal with Nexstar Media Group that is going to broadcast the previously streaming-only rounds on the CW network. The companies did not release details about the deal's value, but the move comes as LIV Golf positions itself as a rival to the PGA Tour through efforts including poaching players and offering large guaranteed funds. Live Golf has recently attracted controversy for its substantial backing from Saudi Arabia, including sponsorship deals and funding from that country's sovereign wealth fund. Jared?
Don't underestimate the Fed. The markets might be underestimating inflation and underestimating the heights and duration the Fed is willing to go to fight it. One analyst saying that we could be in for a crash landing as reality hits. And joining us now is David Neuerhauser, Livermore Partners CIO. And David, thank you for joining us here today. Got to talk about the economy and your prediction for it, because you don't think that we're going to get that soft landing here. And I've been looking at the global credit impulses contract, in fact, crash last year, pointing to something happening maybe March, April of this year. Just wondering if that's aligning with what you're looking at. What's the potential downside scenario in terms of the economy and markets?
Yeah, so that's an excellent question. So I think, Livermore, focused last year, actually going back over about a year and a half ago, is when we became extremely bearish in terms of the market dynamics. And also in terms of technology, because of course they have the highest growth stories, they have the highest multiples, and any changes to the Fed funds rate and the discount rate will ultimately affect their earnings in a big way. I think a lot of investors were caught flat-footed because they've seen from the past decade that this sector was like the best sector to own, and they weren't prepared for what occurred. So we were upfront on that with our hedge fund, and it served us really well as we profited on the short side. Today, like you described, I look at 2023, trying to determine, what is sort of the path of the economy, what is the path of the market, and I think a lot of that will still be dictated by the Federal Reserve as far as how hard they move on interest rates. So that'll determine, of course, ultimately, I think, where things shake out. But our view is that the terminal rate for interest rates is going to be around 5%. It's going to stay there. It also has the potential to even climb to 6%. I think the market is ill-prepared for anything like that, even today.
Where do you think rates are at when the effects or the early effects of what could lead to that crash landing is starting to brew or starting to take form or take shape?
Well, you're seeing some of that today. Mm-hmm. So, for example, we were, our fund was short a lot of these tech names because, again, they're the highest values. A lot of them fell, 50, 60, 70%. We were short things like Tesla and ARK Innovation and Coinbase and all these things that were trading at kind of crazy multiples. And we're pretty public on it, too. So you could actually see that if you're able to search that. But today, looking forward, a lot of those multiples have contracted. So even though I'm still pretty bearish on that sector, I think what it'll really affect is, and you're starting to see it today, is some of the subprime and some of the credit areas. So you're starting to see credit quality weaken. You saw that with even the banks this week with some of the news out, Capital One especially, and they're starting to see these layoffs. That'll bleed into the economy as far as a further downside and weakness in the economy. And I think ultimately that'll affect earnings. Ultimately, that affects the market.
I want to talk about gold here and then relate it back to a prior comment you said. On the Wi-Fi Interactive, I'm just going to show a 5-year chart of gold, and you can see we've been kind of treading water going sideways since early 2020, had a little bit of a fake breakdown here. But you said something really interesting a couple minutes ago. You said potential for 6% terminal rate with the Federal Reserve. Market participants not expecting that. I got to think that real yields are just going to shoot through the roof if that happens. And what does that do for the price of gold in that scenario? How does it end up eventually?
Yeah, so again, very good question. I think historically, when you look at gold, you see that gold in a lot of ways will have issues with the de-risking of it. And I think in this regard, gold will outperform because the 10-year rate is still substantially lower. And ultimately, that'll be the focus.
David Neuhauser, Livermore Partners CIO, thank you so much, Sheriff, for joining us and taking the time here this morning. Appreciate it. Coming up, everyone, we're going to head back out to Davos to talk the future of the education system with the Chegg CEO, Dan Rosenzweig. Coming up.
As we continue to wind down our coverage of Davos, Julie and Brian caught up with the CEO of Chegg, Dan Rosenzweig, to discuss the future of learning as well as the lasting impact COVID-19 had on the education system. Take a listen.
Our focus has been on the student. If you're going to Dartmouth or you're at Barnard, of course you're thinking in person. But let's be honest. 70% of all kids that go to school in the United States, higher education, go to a state school. They're very large. It's not Dartmouth, it's not Barnard. So those environments are unique, they're very expensive, they're very they're determine, what you want to learn, who's going to teach it to you. Most of the other people in this country, 88% of them go to college to get a better job. The people that go to Barnard and Dartmouth assume they're going to get a good job. I mean, they may be nervous about it, but so I think we should stop trying to convince people to do one thing or the other and make all of it available and allow for whatever's best for their lifestyle. So when you recognize that the average age of a college student is 25 years old in this country, Many of them, 62% of them are women. Overwhelming majority are single women who have kids that are going, that are the older ages. I can't bring them into the classroom. They have jobs, they have kids, they have lives. So I think the mistake that people are making is thinking there's one size fits all.
When you talk to educators of various institutions, are they telling you that students are still burnt out and they're still dealing with attention span issues, 2+ years into the pandemic?
Well, the latter, yes, but they were dealing with that before the pandemic. I mean, we live in an instant gratification society, so we've trained our brains to every second have another stimulation. So that's been a challenge regardless. I think the incoming freshmen, I think it's almost back to what historically would have been considered normal. There's still 1.5 million people that left the system that haven't come back. Those are the people that are out there in the employment markets that used to go to community colleges or online schools or go to the 4-year schools but never really intended to get a degree. But I would say that there is normalcy in terms of the standard college student these days.
Do you think that because of talking about sort of coming to the student where they are, giving them what they need in the suite of choices, there's so much talk about upskilling over the past few years and trying to build the workforce that we need in the U.S. Even with the slowing job market, there are still those gaps. What percentage of education 5 years from now is going to be like it looks right now, right? Are we going to just see an overhaul of necessity?
There should be an overhaul. I mean, that is the exact right question to ask. What you're going to see, what you have been seeing, is the students are moving away from traditional education to skills-based education that will allow them to be employable. So, the United States economy has evolved from an agricultural economy to, a manufacturing economy, then the knowledge-based economy, and now it's going to a skills-based economy. Do you know how to do this? If so, I will pay you, and I will pay you well. So I think the students are showing it where the biggest trends we see, more people going to the 4-year state schools, like, look, if I can't get into the elite of elite of elite, why wouldn't I just go have a great time? Because what's the difference between education here, here, here? The second one is because the U.S. finally started investing in historically black colleges and universities. There's a real surge for people of color to go to those schools. And then there's a very big surge in online-only schools. So that's where students are voting with their time, energy, and dollars, and I think you're going to see schools having to evolve or they will go away.
Well, on the topic of evolution, Julia, this is something you and I were talking about. This is, I would say, the first World Economic Forum where AI is being talked about in a different way. ChatGPT, these programs are coming to market, and they're coming to market in a big way. How do you see that changing what you do at Chegg?
Again, a really fair question. So obviously Chegg has been using AI and machine learning for quite some time to offer our services. I think we'd all agree that AI is now here in a significant way and in a more public viewing way. I also sit on the board of Adobe, as you know, and we have generative AI, and what they can do with images is just extraordinary, and you'll see all of these things coming out. The question, there's a lot of questions around AI that have to be asked, legal questions, ethical questions, who owns this, who owns that. But in the interim, as it relates to Chegg, we will and continue to use it to enhance what we offer. Categories that we're not particularly deep in that we also want to provide inside our service. But I think we'd all agree after using ChatGPT, even as extraordinary as it is and even as the evolution that's going to come, it still needs human editors. Kids need to be certain that the information is correct. They don't learn one time in one way only. They also don't have the time to educate the system to get the information out that they want. So the user interface, although cool, isn't really valuable to the students who are looking to learn and to evolve and need multi-platform, multimedia way of learning. So we'll use it to continue to enhance what we offer, and that's why our service gets better and better and better, and our NPS scores are through the roof. And so actually, I think it's going to be a real benefit to Chegg.
I want to switch gears as we wind up here. You've been in the tech and internet industry pretty much since the beginning of the internet. I don't know if I would go that, but you've been doing this for a long time.
1983.
Okay, well there you go. Yes, so before
10 years before I was born.
I was born.
So, what do you make of this current cycle and where we are right now after what it was a horrible year for most tech stocks? Now in a period of belt tightening for the industry, we're looking at a slowdown in the economy. What are your thoughts on it?
My thoughts are that it's following very normal patterns, which is, there was 1987, there was 1991, there was 2001, there was 2008 for other reasons. These things are like a pendulum. So The overhiring was a result of people not really understanding the impact and how long the pandemic would last and what was permanent behavior and not permanent behavior. Also, investors were starting giving these incredible multiples to companies that were growing fast that would never have a chance to make money. So I think you're seeing, as the market resets, you're seeing CEOs try to understand better two things. What is the real opportunity available? What do I need to support that opportunity and create great experiences and products and services, whether it's B2B or B2C? And then also, what is the investor community comfortable in you doing? We are very fortunate at Chegg as we're not doing layoffs because we were very judicious. We sensed this was coming. We had the canary in the coal mine with college students. And so we've been able to grow and get even more profitable and have free cash flow. I think we're the only ed tech company that is profitable. So I think in the tech cycle, it has a very short memory. It's like, it's like the goldfish. It immediately forgets. So you're going to see AI now, you're going to see huge valuations, Microsoft and OpenAI. I think.
Is it just the tip of the iceberg, Dan? These Amazon layoffs, is it a one-off company specific, or we can now see more mass layoffs at other big cap tech this year?
Well, they sound like mass layoffs because there's a lot of people whose lives are being affected, and it's terrible. But when a Microsoft lays out 11,000 people, it doesn't really matter. When Salesforce gets rid of 7,000 people and it's got 80,000 people, it's not that as a percentage of the universe. And fortunately, most of those people are still able to get jobs because even though companies may not be hiring as much, they've had open jobs that they've not been able to fill that now they can fill. I don't know that it continues at any significant level in terms of the same company going over and over and over. I do think that the larger companies are going to go first because they have the greatest clout and the greatest strength, and also it's the biggest numbers. But I think they'll set the tone for other companies. I hope that it doesn't continue. What I would say is companies can't sustain themselves if they can't be profitable. The public markets are not going to open for companies that are unprofitable in the near future unless it's, again, one of these new unicorns of AI. So we'll see how it plays out.
And that was Chegg CEO Dan Rosenswag speaking with Yahoo Finance at the World Economic Forum in Davos, Switzerland. Coming up, StockX enters January following a record-breaking year in 2022. We're going to sit down with the CEO next. StockX enters the new year following a record-breaking year in 2022 as more consumers turn to the secondary market searching for products on their wish list. Here to discuss top traded brands over the past year and insights into 2023 trends, we've got StockX CEO Scott Cutler. Scott, always a pleasure to grab some of your time and speak with you, especially off of this big facts report here. First and foremost, when you think about the trends that are perhaps best slated to hold up in 2023, what comes to mind, and are you expecting any kind of brand reset in terms of affinity among consumers?
Well, it was a record year for revenue, record year for trades, record year in terms of surpassing some of the levels that were achieved, obviously, in 2020 and 2021. I think in the sneaker industry itself, what's interesting about 2022 is that the top brands remained the same. They didn't change much from 2021, but we really saw some emerging brands across lots of different categories. So a couple of examples of that: Solomon up over 2,000% year on year. Hoka as a brand also seeing great success in shoes. Uggs in shoes really seeing a real excitement in the secondary market. If you looked at apparel, another example of that, Fear of God took over Supreme for the first time in StockX history, which we were really excited about. But also other brands and accessories, for example, Swatch, thanks to its collaboration with Omega, or New Era with its collaboration, some of its collaborations with Murakami or Fear of God, were a couple of examples of breakout brands among hype culture that really found great excitement among consumers this year.
And Scott, stepping outside of apparel and sneakers for a second, got to go to your number one collectible here, and it's Lego. And you're saying it climbed up 2 spots on the list. Can you tell me about some of the other collectibles that you have and the interest that has been generated since the pandemic in these other categories?
The collectibles have been an exciting growth category for us for a number of years. It includes trading cards, but also it includes art and other brands, for example, Bear Brick and Cause, which have been traditionally one of the highest in collectibles. But Legos overtook them all to be the number one among top traded collectibles. And this is, again, a resurgence of a great brand, but also, again, something that in the resale market a couple of years ago we really didn't see, and it really exploded over the course of this last year.
Scott, as you're kind of monitoring the consumer environment, of course, consumers are looking at some of their discretionary spending and trying to figure out exactly which items they value most at this point in time. And this has led some companies in the discretionary category to restructure their cost basis in the meantime as well, looking at some of those margins. Is that something that StockX has had to think about, whether that be on just an expense for perhaps headcount? Has headcount reduction had to be something that StockX has had to think about as well?
So a couple of things. Clearly, the macro environment for the entire technology industry has been more challenging 22. We probably expect it to continue in 2023. That impacts everybody. Consumers overall, you have to remember that 70% of US GDP is the consumer, and the consumer has faced incredible challenges over the course of last year, which has really left consumers to changing behaviors and habits, and even the amount of money that they can spend, certainly in discretionary categories. For us as a platform where we represent current culture, but we're also represent a demographic that wants access to the greatest products that are still released by brands. So even in a tough macro environment, brands are still trying to inspire consumers, and StockX has always been a platform about access and be able to access those products that you can't find anywhere else. As a company, we've of course had to be able to respond to a couple of different things. One, the macro environment has been challenging, but also the investor expectations for growth have changed very dramatically in a very short period of time, away from a focus of growth and much more towards sustainability, sustained profitability, which has required companies like us, as well as companies like Microsoft, Facebook, and Google to reassess how sustainable their businesses can be with certainly a much more dovish macro environment, but also as a CEO, how you manage that across a cost base in a growing company.
This time last year, there were a lot of kind of speculation, rumors on the street that StockX might be going public. Scott, I always like to check in. What is the appetite for making a debut in the equity markets?
Well, I think it really starts first with what the investor sentiment is around growth and technology. The IPO market has been closed. But I think importantly for StockX, that's not our focus. Our focus has really been executing through this environment, focusing on the areas where we can control growth in the platform. And that's really been focusing on the international expansion of our business, which continues to grow, and to be able to focus on category expansion and creating a better product experience. And that remains our focus in this environment.
All right, fun stuff as always. StockX CEO Scott Cutler. Coming up, we're back in Davos, Switzerland, and we're going to bring you an interview with Novartis CEO. Up next. Yahoo Finance's Julie Hyman had a chance to speak with Novartis CEO Vas Narasimhan at the World Economic Forum in Davos. They spoke about everything from drug pricing to the future of medicine. Take a listen.
There's a lot more sensitivity to the impacts that health can have on economies and overall stability in countries. But I do think there are opportunities for us to improve. I mean, one concern I have is with the overall macroeconomic situation that we see right now across all of the geographies here at the WEF. You see the need to pull back financing, and will there be a pullback on financing for healthcare, particularly in low and middle income countries, but we also see that in Europe as well. And this is not the moment, I think, given all of the non-communicable disease, which wasn't treated during the pandemic, for governments to pull back on their investment in health. So one of our key messages has been to government leaders: you have to keep investing in health, keep investing in new technologies, keep being ready so that your healthcare systems are more resilient.
Are they pretty receptive to that? Are you encouraged by changes that you've seen in, or at least progress that we've seen in healthcare systems around the globe?
I think the pandemic allowed us to accelerate certain parts of resilience. I think there's a lot more sensitivity now in building strong supply chains for health products and vaccines, which is positive. That said, I think it's interesting to me how, one, we didn't make a lot of progress on pandemic preparedness for the future. That really hasn't taken off. And two, we already see signs that governments are pulling back healthcare spend as they face a fiscal crunch that we know is going to happen with the macroeconomic situation we're in. I think what government leaders have to understand is that has long-term consequences. We know when you invest in health, you ultimately get better economic growth and also can reduce your expenditures in the future. So let's see how it goes. You know how these things are. I mean, right now we're a moment in time where the focus very much is on how inflationary pressures are going to lead to potential recessions in Europe and in the U.S.
And how's that going to affect your business? I mean, the conventional wisdom is typically that healthcare holds up relatively well during a recession. But of course, healthcare has gotten more expensive, so some of it maybe is seen by people as more discretionary, even if it's not really. Drugs are expensive, so how do you think this is going to play out this time around?
Net for us, I think we're still on a very good trajectory. There's pushes and pulls. I mean, one thing we have is a lot of pent-up demand from non-communicable diseases which weren't treated, particularly in China, but also in other parts of the world. And so that's going to lead to an increase in demand for many of our medicines. That's a net positive. We have new launches, new products, new innovations coming forward, whether that's in cancer or cardiovascular disease. That's also, a positive, tailwind for our business. The headwinds, though, are, like I mentioned, like if you look in particular European governments, there's a push right now. We saw one example in the UK recently to pull back on spending on medicine and spending on healthcare. So that's the headwind we face. Still, I think net, I expect the sector to grow mid-single digit overall, and we also are on a good trajectory for 2023.
Does Novartis today look how you want it to look? In other words, you're not alone, certainly in the industry. There's been a lot of restructuring over the past several years, remaking, refocusing drug businesses. So where are you in that process?
I always think back and look at the long history of a company like ours, 250-year-old company. 25 years ago when Novartis was created in its current format, we were a broad healthcare conglomerate. We were in everything from baby food to generics to animal health. Now, over the last 5 years, we've done over $100 billion of transactions to focus ourselves on what I think is what we're best at and what we can have the most impact with is innovative medicines. And with the planned spin of Sandoz this summer, as you know, the generics business gets spun, we'll be a pure play innovative medicines company. What we're going to focus on are 5 key therapeutic platforms where we think we can generate the most drugs. 3 of those platforms are things we call advanced technology platforms. So it's things like cell and gene therapies and radioligand therapies, places where we think that's the future of medicine. We'll continue to be a global player. We're the most global, we think, drug company in the world. We market our drugs in 108 countries, but a big focus on US, Germany, China, and Japan. That's where we think we'll have the most impact. And so taken together, I think it's a good setup for us now to be very focused in a really complex world and focus our capital on technology, on the future of medicine, and hopefully bring great medicines to market.
What's your take on the gene therapy business? I know some of the experimental treatments have not turned out, some of them have. Where do you go from here? What's the strategy for that in 2023?
Gene therapy has recently gone through a little bit of a nadir because we were the first company to launch a global gene therapy. It's been very successful. It's a blockbuster medicine, Zolgensma, extraordinary in that it can turn around the lives of children who face near certain death with a single injection. But then we learned how hard the science is, how hard it is to deliver gene therapies to the right place in the body, how hard it is to get the right approach in terms of avoiding side effects. And so the field had to go through a lot of work. But my expectation is in the next few years across the sector and in our company, we'll start coming forward now with more gene therapies. What will be really important is, one, to be really educate healthcare systems again on how to fund one-time therapies. We unfortunately haven't made a lot of progress on that front. One-time therapies are very different than pills that are taken over and over again for decades. But net, I think over the next 5 to 7 years, we will see a gene therapy renaissance, I expect.
Vas, finally, a little bit more of a personal question. You're a relatively young guy. You're an American guy running this enormous Swiss pharmaceutical, as you said, 250-year-old company. Kind of as you reflect on how you got here and where you want to go from here, what are some of your takeaways? Like, how did you end up doing? I mean, it's, I think the last time we met here in Davos, I was struck because I think we're around the same age, and here you are running a $200 billion company.
Well, the beard is getting a little grayer, but overall, I've been extraordinarily fortunate. I feel tremendous gratitude. I mean, my grandparents came from villages in India, and now I stand leading one of the largest and most important companies in the world. So I start from a place of gratitude. I've been very fortunate as well to have a lot of different experiences in R&D, in business, as a physician scientist, to now bring to this role. And I think it's just an amazing opportunity to shape global health with such a position as Novartis. So when I look ahead and I see all of the technological advances we have, on the one hand, I think we can still keep pushing, let's call it the high science, and at the same time bring access to hundreds of millions of patients. At the end of the day, for me, what gets me up in the morning is the fact that we reach 300 million patients a year with these medicines. And for a physician scientist, there's nothing more you could hope for, I think, in a career.
Welcome back, everyone. Well, coming up, Google calls old friend Larry Page for a new venture. We're going to tell you what he's up to in this week's Cut for Time. Welcome back, everyone. It's time for Cut for Time. We've got 3 stories, 1 minute on the clock for each. We start with this. The FAA said that the system failure that resulted in over 10,000 flight delays last week was caused by the accidental removal of files. A review found that contract personnel unintentionally deleted files that helped the pilot alert system run properly, which ultimately caused massive cancellations, cost airlines billions of dollars in totality there. But this was, an event where many of us became a little bit more knowledgeable of the acronym NOTAM, the Notice to Air Missions, and the system that a lot of pilots, a lot of those that are making sure that operations run smoothly in the skies, that they can go forward.
Yes, I was at the airport that day. I was on my vacation.
Oh my
had
gosh.
A family member in town. They were going back a little bit early, and yes, their flight was delayed, but we got them there on time. It strikes me, this is interesting. You know, we had this outage with Southwest in late last year. I'm going to draw a parallel here. And when you think about that outage, they failed to. Well, I guess we're out of time here. Anyway,
the buzzer. We got buzzed.
Go. Oh, Google founders Larry Page, Sergey Brin, they reportedly had held meetings with Google's executives to strategize the future of AI and ChatGPT's threat to its $149 billion business. Page and Brin had not spent that much time at Google since they left their roles in 2019. And Brad, you know, everybody here knows that I've become a recent fan of ChatGPT, maybe obsessed, and I see this thing is so far beyond what a search engine does. Google needs to get on top of this and add this capability capability now because ChatGPT, if it simply adds search, it's going to be ahead of the game, I think.
I mean, we've already seen the considerable investment that Microsoft intends to continue layering on to what they already not just knew about ChatGPT and what it could mean for its Bing search, which, again, when's the last time you searched or originated a search on Bing? Microsoft hoping to change that here. And I think for Google, they're saying and issuing these code reds internally to say, we need to be able to catch up or at least make sure that we're keeping pace with this rate of innovation. And AI, one of the big topics at Davos, yeah. Also, Starbucks might have a cup problem. A new report from Business Insider says employees in 5 states have said that the lids, they're not fitting on the cups, which is causing them to fall off when handed to customers here. Okay, well, this is, of course, a sticky situation or, just one that not as an employee or a customer you want to be in, because God forbid you're the customer side and you make it all the way out the store and the lid just falls off. Yeah. So, I mean, at the end of the day, that's, I don't know. That's a serious quality assurance.
Well, I mean, the cup is supposed to do one thing. It's supposed to hold the liquids, and the lid is supposed to prevent that from spilling. If it's not affixed, then I think this is quality control kind of growing out the window with all the inflation that we had over the last year and a half. I think that's going to ameliorate. But also, too, the green movement also propels companies to invest in different technologies. Some of these new materials or different materials don't hold up as well. It is a sticky situation.
No, it's a considerable, I think, quality control measure, and that's some anecdata that we've continued to hear from customers out there too. That seems like quality has kind of deteriorated.
Not job one.
Yeah. Also here, let's take a last look at the markets here as we are approaching the top of the 11 a.m. hour. Major averages in positive territory across the board. Coming up, we brought you in and out of Davos this week, but what exactly came out of it all? And does it even matter? Rochelle Kufo breaking down the Davos disconnect in this week's What Just Happened.
They've been described as the masters of the universe.
Unless we see unemployment move up, I think it's hard to square that with a recession.
Every year, a small village town in the Swiss mountains becomes overrun by CEOs, policymakers, central bank governors, and media outlets from every corner of the globe. After last year's summer outing, the good and the great are back in the cold, and the outlook seems frosty at best.
I don't think that we are too deep into recession so far, right? It depends on the industry.
But I am personally optimistic that there may not be a recession, or if there is one, it'll be short and shallow.
Overall, I sense there's still more optimism here than what's sort of being portrayed relative to this fear of a recession.
This year's World Economic Forum, perhaps unlike any other, the title, Cooperation in a Fragmented World, might be putting it lightly. A global economy still battling the highest inflation in decades.
So I think there will be parts of the world that go into recession this year, but we will choose to ignore that in the parts of the world that are enjoying continued growth.
Trust in institutions ebbing.
Well, you know the vibe here, because everyone is fairly on the bearish side. Everyone's talking about global recessions.
A war raging on the very same continent.
It's not a war. It's not a special operation. It's genocide and terrorism.
Old friendships tarnished and new alignments taking shape. Add to that the risk the financial system is once again buckling under its own weight.
FTX and SBF are not an exception. They are a rule. 99% of crypto is a scam.
For 1 week, an opportunity to speak truth to power.
That's Elon Musk, that's Jeff Bezos, that's Mark Zuckerberg. But the fact is that those people worth hundreds of billions of dollars also, at the same time, have literally no interest or conception in their role as stewards for civil society and American democracy.
When we see people in the tech industry really struggling, the idea of throwing in flying in a big performer, spending a ton of money on a lavish party didn't make a bunch of sense.
And a chance to make sense of it all. We hear from the small group of individuals whose decisions impact all of us. Welcome to What Just Happened, Yahoo Finance's deep dive into the story dominating the news agenda. I'm Rochelle Acutho, and today we're taking a closer look at the World Economic Forum after a week of high-level discussions in the economic, business, and political arenas. Yahoo Finance's Julie Hyman and Brian Sozzi rubbed shoulders with the best of them, and they broke down all the buzz on the Alps.
We're wrapping up our 2023 coverage of the World Economic Forum in Davos, and our three top takeaways is what we're going to give you right now. First of all, when it comes to the economy and what we're hearing on opinions, not a huge amount of doom and gloom, right? There is definitely caution. There's definitely the view that things are slowing down globally, but many companies telling us their businesses are still in decent shape.
No, right, Julie. You don't get the sense, I think you used it in another interview, cautiously optimistic. And I think that's a fair way to put it. Companies are cautious on the outlook for this year and I would say earlier next year, but they're not seeing orders completely fall off a map.
Right, and they're seeing it sort of patchy in terms of where demand is decreasing. All of that said, as we have pointed out before, the people in Davos are not always correct, right? Consensus is not always correct. So take all of this with something of a grain of salt.
And what we could agree on, and this is my takeaway, this was the World Economic Forum where, Julie, I think artificial intelligence took center stage, but not just the artificial intelligence or AI of the years past, next level. A lot of conversations I had were on the outlook and what ChatGPT might or may not mean to tech, but a lot of other industries, some see it as a job killer, some see it as a necessary evil to drive productivity inside their organizations.
Yeah, among others, we talked to Dan Rosenzweig of Chegg about what AI is going to mean for education, and he was pretty positive on what that's going to mean. In fact, there was a lot of positivity and not so much the sort of dystopian vision of AI taking jobs, but rather sort of augmenting what people are doing. And then the third takeaway, Russia-Ukraine still very much a topic of conversation here, even as it has maybe fallen out of the headlines to some degree. I talked to Samantha Power about the U.S. support for Ukraine, not necessarily militarily, but in other ways, helping out with the infrastructure. I talked to Robert Smith of Vista Equity Partners about how important it is that the conflict conclude, both from a business and democratic perspective.
As the World Economic Forum gathered leaders from across the globe to the Alps, here's what top execs had to say on what drives attendees to make the trip to Davos in the first place. Take a listen.
It's a good place to listen and learn and build your world view. Secondly, it's super efficient for us to meet our partners, lots of our business partners, partners from civil society, some government.
You can walk down the street and see people from administrations around the world. You can see business people from around the world. You can see advocates of all different types around the world. So that's the value.
One of the big benefits of Davos is really listening. And listening what others are doing, what others are thinking, what others are feeling, and use that to really redesign the plans for the company, but also for some personal experience.
There's no doubt that there will be some value from the WEF's global meetup in Davos, but there's also clearly a level of criticism putting this annual meeting under the microscope. Joining us now to discuss is Bill Browder, Hermitage Capital Management CEO and author of Freezing Order. Good to have you, Bill. So for a lot of people on the outside looking in, it looks very glitzy. It looks like, a lot of leaders and CEOs rubbing shoulders. In terms of the value that you got out of Davos, what would you say is really the selling point here?
Well, I've been going to Davos for many, many years, 27 years. I started out going as a businessman when I ran the Hermitage Fund to invest and meet with investors. And then after I was expelled from Russia and my lawyer was killed in 2009, I became a full-time human rights activist. And Davos actually had more value to me as a human rights activist because I could go there and meet with the heads of state, with members of parliament, with heads of other human rights organizations. And I could push very hard for different types of actions, including legislation called the Magnitsky Act. And so for me, the congregation of important individuals from around the world really was a great blessing. And that's what attracted me for many years to go there.
Now, Bill, I want to ask you about the price tag, because your tweet about the WEF raising your admission price by 300% to $250,000 got a lot of views, millions of views, a lot of commentary here. How does having prices be so restrictive? How does that affect the kind of voices that get a platform and the kind of issues that really come to the forefront at these meetings?
Yeah, well, it's an absurdity. So at the end of Davos last year in May, the organizers came to me and said, Mr. Browder, we're now going to raise your price. And I had been grudgingly paying the $70,000 fee for many years because of this. As I mentioned, it was really good to be around all these important politicians and heads of state. But when they wanted to raise the price to $250,000 for me as a human rights activist, I'm not making any money out of this thing, to show up in Davos, that's when I said no. I could no longer justify that cost. Now, I still went to Davos. But instead of going as a participant in the official halls of the Congress, I could only go to unofficial events outside of Davos, outside of the official conference center, which certainly would have reduced my efficiency. And from my perspective, Davos has a responsibility. They've been granted the same status as the World Health Organization and the International Red Cross as an international organization. And with that comes a responsibility, which is that they can't be sort of jacking up prices on activists and trying to profit maximize. If they want to be an international organization, they have to behave like an international organization. And that requires, first of all, transparency, who's getting charged what. And secondly, not to try to price gouge people who are activists trying to make a point. And my point was particularly relevant because it's all about getting tough on Putin, containing Russia, and helping Ukraine, which is something that I would have liked to have had more of an opportunity to talk to the people inside the Congress Hall about.
And you figure, especially as WEF has talked about this poly crisis, this convergence of macro issues that different countries have a lot of push and pull with at the moment, a lot of people wondering, look, is globalization dead or is it on life support? What do you think?
Well, I think that what's been going on for many years is everybody looked at every other country and said, well, that we can all do business with each other, it's all fine. And I think one of the things that's been discovered from Putin's invasion of Ukraine is that there are some countries that you just shouldn't do business with for moral reasons, but but also for business reasons. I mean, anybody who had business in Russia and who were ignoring dictators ended up losing everything. And so now we're in a situation where people are saying, well, maybe the same thing could happen in China. What should I be doing about sourcing from China or selling into China? And so we're now in a world where it's kind of pairing off between the democratic, free-thinking countries and the dictatorships. And it's no longer a global world. It's a world where we have to sort of really kind of be careful and make very big decisions, value decisions about who we want to do business with.
And so then, as you look at what Davos is now versus its initial iteration in terms of solving the world's problems, bringing business and politicians together, do you think in this current iteration that it's successfully doing that?
Well, it isn't in my case. I mean, I'm a civil society activist. I'm a human rights activist. And they specifically deplatformed me by raising the price by 300%. And so I think that it's kind of a fig leaf. Their motto, committed to improving the state of the world, is kind of a nonsense if they're trying to charge the biggest anti-Putin activists $250,000 just for the privilege of showing up. It doesn't make any sense to me at all.
Certainly, the math does not add up when you think of the impact that the Russia-Ukraine crisis is having on all these discussions. A big thank you there to Bill Browder, there, Hermitage Capital Management CEO and author of Freezing Order. Thank you so much. All right, up next, what just happened? The political take on Davos. Yahoo Finance contributor Kevin Cirilli, it's over to you.
Well, we'll break down the three biggest political takeaways. Even as President Biden did not attend Davos, Treasury Secretary Janet Yellen did, and U.S. and China trade relations were on front and center at Davos. That's coming up next. I'm Kevin Cirilli. This is Yahoo. I'm Yahoo Finance contributor Kevin Cirilli reporting from Washington, D.C. And while President Biden did not attend the World Economic Forum in Davos, policymakers from the nation's capital were felt, and their presence were talking about everything from climate change to electric vehicles to trade competition with China. And that's the first of my three biggest takeaways coming from Davos. Treasury Secretary Janet Yellen did meet with her Chinese counterpart, Vice Premier He, And while the two had a somewhat amicable meeting talking about global trade and global supply chains, there were some other developments on the sidelines and reports on the sidelines of the US and China strategic competition that had a lot of investors wary of just China's long-term growth. We should note that China's GDP in 2022 was just increasing at 3%, according to the Wall Street Journal. That's the second lowest annual GDP growth since 1976. And China also reported a population decline of 850,000 people. That's the first decline since the 1960s. Remember, Beijing wants to see Washington lift some of the Trump-era trade restrictions that the Biden administration still has yet to lift. And they also would like to see some of the export controls that the Biden administration put into place around semiconductor chip manufacturing lifted. Those went into place last October. Based upon the conversations that I'm having, I just don't think that that's going to happen. But artificial intelligence, and we've heard this across the Yahoo platform, was also something that the US, as it relates to China, put front and center. In addition to Secretary Yellen's meeting with the vice premier, I was struck by FBI Director Christopher Wray's comments on the main stage at Davos speaking about artificial intelligence. He said, quote, that China has artificial intelligence ambitions that are built on top of massive troves of intellectual property and sensitive data that they've stolen over the years. That's something we are deeply concerned about. And I think that everyone here should be deeply concerned about it. That's according to the Associated Press. So US and China front and center. Secondly, second big takeaway coming from Davos, Ukrainian President Vladimir Zelensky appearing virtually, speaking at Davos from Kiev, urging the West, urging the United States to continue their support, both economically and militarily, for Ukraine to defend itself against Russia's invasion of Ukraine. Take a listen to what President Zelensky had to say.
The supplies of Western tanks must outpace another invasion of Russian tanks. The restoration of security and peace in Ukraine must outpace Russia's attacks on security and peace in other countries. Russia is exporting terror. Russia is spreading the strain of the war across the world. Ukraine offers the world a peace formula. Please, 10 steps that the world must make faster than Russia makes its new moves.
Now, President Zelensky's comments come as a growing number of ultra-conservatives have raised concerns about economic and financial support for Ukraine, but many military hawks in Congress and in the Senate continue to make this a bipartisan issue. Thirdly, speaking of the Senate, there was a small contingency of centrist senators who attended Davos. Senator Joe Manchin, a Democrat from West Virginia, as well as Senator Kyrsten Sinema, the newly crowned independent. She left the Democratic Party. She represents Arizona, but she still primarily caucuses with center-left Democrats. They made a bold announcement in a high five that perfectly illustrates just how much influence they have in the Senate. They've doubled down, rather, on their support for the Senate filibuster. There was one moment in which Manchin turned to Sinema and said, "We still support the filibuster, right?" And she said, "Yeah, we do." And they high-fived. Why does that matter? Progressives have been assailing them, saying that they need to get rid of the filibuster. But this serves as a guardrail and a check and a balance in order to provide 2/3 of a majority in the upper chamber before bringing any type of major piece of legislation to a vote. So when you have divided government like the U.S. has, or a very close divided margin in the Senate like the U.S. has, it makes it even more difficult for massive pieces of legislation to move through on a whim from the upper chamber. So Senator Joe Manchin, Senator Kyrsten Sinema, really essentially saying that they've got a grip on the middle and the centrists in the Senate. So those are my three takeaways. But who knows what's around the corner coming from Washington, D.C. But it was striking, I think, to hear domestic politics interplay with the geopolitics, despite President Biden not attending. You know what I mean?
I mean, it's never dull in Washington, even when Biden's not attending, clearly. Yahoo Finance contributor Kevin Cirilli, thank you so much.
Thank you.
All right, coming up on What Just Happened, recession is the word. Is it coming? Will it be mild? Are we going to have a hard or soft landing? Julie Hyman and Brian Sozzi got their fill of economic predictions in the Alps. We'll make sense of it all next.
I think everybody is worried right now. I mean, I think it's affecting everybody's mindset.
There are significant challenges when we look at the impact of inflation, the impact of the war, the increase of energy prices, the situation in China. Each of these things could drive for a recession.
The tone has been much less pessimistic than I anticipated. And certainly while recession is likely in many economies, the thought about soft landing and not as deep, the fundamentals are much stronger.
Overall, I sense there's still more optimism here than what's sort of being portrayed relative to this fear of a recession.
Well, those were just some of the big names out of Davos talking inflation and the global economy. Now, earlier I caught up with Rich Lesser, Boston Consulting Group Global Chair, and we discussed the landscape for businesses in a fragile economic environment. Take a listen.
It's very interesting because, like you, I read all the headlines going in, and I expected to have a set of conversations with leaders around the world that was on average pretty negative. And that was not the mood I picked up. I mean, there's certainly a huge amount of uncertainty. There's no question. We learned when we did this virtually last January that things can change radically even within a few months. So no one's underestimating the uncertainty, but I think on average, there's much more optimism than I had expected to hear. To be honest, personally, I went into it more optimistic than what I was reading in the newspapers, but that was echoed not in every conversation, but in many of them. And I think people see some pretty good signs on the economic front as it relates to the U.S. economic inflation. Core inflation's pretty reasonable the last few months. I think Europe's weathering the energy storm better than people anticipated. We're lucky it's a milder winter. Energy stocks are pretty good. And obviously what China has to go through in this month and next month is pretty brutal. But I think the expectation is that by the last 3 quarters of this year, it should be pretty strong again. So I would say overall, now when you get beyond the economics, certainly there are concerns about what's happening in Ukraine, that the war seems to be being prolonged. You have, geopolitical tensions that remain high, even if they seem to have maybe improved a touch. So there are elements that are a bit challenging still, and very challenging. I don't want to underestimate that. But economically, I think it's far less gloomy than I anticipated.
And as we've been mentioning here, in person for the first time in a long time, but we didn't see a lot of G7 leaders attending this. We saw some CEOs, including Elon Musk, declining the invitation. Is there something that ends up getting lost when you don't have as many CEOs or you don't have as many G7 leaders at an event like this?
So I think there were a lot of business leaders here. I mean, I can't ever remember seeing Elon Musk at a World Economic Forum. I'm sure he must have come over the last decade, but I mean, so there are some people who have never come, or rarely come, but there were a lot of CEOs. The Alliance of CEO Climate Leaders, where I'm the chief advisor, we had 80 CEOs of big companies in a room talking about how we accelerate progress on climate. All those companies to be able to join have to have already made big commitments. I mean, it's probably one of the strongest collections of CEOs in the world. There were a number of of government leaders there, certainly, who spoke during the week. But at least what I read was perhaps a few less than normal. But there were also a lot of the leading NGOs there. So I found the collaboration across public, private, social sectors to be pretty good, actually.
And you figure this sort of collaboration is more important than ever when you look at what happened with the COVID fallout, when you look at things like Russia's invasion of Ukraine. I mean, we've really seen some seismic economic and geopolitical shifts here. So I want to talk about BCG's newest report predicting the shakeout about what this means for the global winners and losers on the other side of this. Which are the trade dynamics that you think have the most impact potentially on markets?
So first, I think that the report in particular highlighted the strength of ASEAN, a strong trading partner to many of the major economies around the world. And given all the desire to diversify supply chains a bit, create more resilience, and so forth, should come out as a winner in terms of overall flows. But you're right, I do think one of the most interesting implications is that we're seeing that for decades, global trade has led overall economic growth, and that for this year it lagged a bit, and that might continue in the years ahead. I do think when we don't have a robust trade regime, obviously it's not optimal from an economic point of view, but as we see, there are other considerations that are going into that right now. And we do still see an enormous amount of things flowing globally. Our young people are probably more connected globally than there's ever been. There's more knowledge of new ideas and new products flowing around the world. So I think the trade report is an accurate depiction of what's going on in the physical flows of goods, but we shouldn't underestimate that in many, many ways it remains a highly connected world.
So then as a CEO who's watching all of this unfold, how do they navigate these changes ahead?
So first of all, there are so many more degrees of uncertainty and pressure that a CEO faces today, even than 5 years ago, that we just have to acknowledge it is a different world. And I hear that, I see that personally, having been a CEO for so many years and talking to so many CEOs now. And and that is the world we're living in. I think it puts a premium on resilience, a premium on agility, a requirement to make investments that allow one to navigate those new sources of data, faster inputs. So we talk a lot about what you do with data, and as we're seeing so rapidly evolve the AI landscape, to be able to interpret signals faster, to be able to respond more effectively, and to really contribute to resilience. Resilience is not just about going from just-in-time to just-in-case inventories. It's about the way you use data and information, the way you learn, the way you work across an ecosystem so that supply partners understand each other's situations, and the way you build deeper relationships with customers. customers that are stronger relationships, often leveraging better insight into what their needs are and helping them to know how to respond to uncertainty and winning their trust as a business partner. So, I mean, those elements of a CEO's job and how they need to lead their organizations are so much greater than they were a few years ago.
And of course, we have to talk about the China reopening picture and what that means for CEOs. How are they viewing this? Because we know there was something of an adversarial relationship when the Biden administration was first trying to navigate what was happening with COVID and the fallout there. But as China reopens, and there does seem to be a lot of optimism really tied to China's reopening, how did you see CEOs discussing that?
So I'd say mostly, look, I think everyone believed that at some point China would need to reopen. I think most people were surprised. In a year of many surprises, at the very end of the year, the speed of that reopening was a surprise to many. And of course, there's concern from just a human life standpoint of what could happen in China and the impact on people there, some of whom are vaccinated, but perhaps not as protected as certainly populations where many people have already gotten COVID and built some immunity naturally as well as through vaccines. So there's a concern about that and what it could mean. But I think from a pure economic standpoint, I think getting beyond this quickly and having China be in a stronger place, I think most of the world believes it needed to happen sometime. The thought was the Band-Aid, so to speak, would be pulled off very slowly. In fact, it will come off quite quickly. Then when you say what it means, I think most people think that's a good sign for global economic growth, that China should have a good rebound, maybe not in Q1, but in the 3 quarters that follow. I do think there's a little bit of concern about what that might mean for raw material inflation, as if China's demand picks up a great deal, if there's a lot of pent-up demand among Chinese consumers, that we might see a resurgence in some of the supply side inflation. On the flip side, some of the inflation caused by supply chains that are disrupted and all of the things we saw last year with the shutdowns, that should minimize. So on net, my sense is from an inflation point of view, it's probably more good news than bad news, but only time will tell.
Well, that was my conversation with Rich Lesser, Boston Consulting Group Global Chair. Well, is the world starting to see globalization differently? Once considered key to increasing trade, fostering peace, and raising the standard of living, globalization is now seeing a pushback. Now, the issue was raised at Davos, with new data showing world exports and imports are now in retreat for the first time since the Second World War. Partially driving this retreat, nationalistic policies and protectionism. All right, still to come on What Just Happened. How did the crypto story go down in Davos? Jen Schonberger, take it from here.
Thanks, Rochelle. I'm Jennifer Schonberger. Coming up next, I'll talk about the week that was for crypto in Davos. That's next. Stay tuned. Welcome back to What Just Happened on Yahoo Finance. I'm Jennifer Schonberger. After a year that saw numerous bankruptcies for crypto firms and the massive failure of FTX, crypto's presence in Davos, Switzerland over this past week was far less than in years past. Far fewer companies were present. Those that remained included stablecoin issuer Circle, the Global Blockchain Business Council, Casper Labs, and the Filecoin Foundation. Whereas last year crypto panels were everywhere, this year the crypto industry blended in with other financial and technology companies. Gone were the crypto houses every 10 feet, Bitcoin-themed pizza stalls, and advertising from previous years. For those still there, executives weighed in on the future of crypto and what the crypto crash has meant for them. Here's what Circle CEO Jeremy Allaire and others had to tell our very own Julie Hyman and Brian Sozzi on the ground in Davos this past week.
USDC has actually grown since the FTX collapse, and it's actually, we've seen other digital dollar infrastructure stablecoins have significant declines while we've continued to sustain. And so, I think regulated, transparent, infrastructure like ours is well suited to this environment.
I think Bitcoin prices will come back, but it will come back in a way more organized way than expected. It will follow the interest rate. So when interest rate starts to fall, the Bitcoin price will come up, and everyone will ask, why did the Bitcoin price go up? It's because of falling interest rates.
FTX and SBF are not an exception. They are a rule. Literally 99% of crypto is a scam, criminal activity, total really bubble, Ponzi scheme is going bust.
Well, Nouriel Roubini, who you just heard from, thinks crypto is finally having its reckoning. Skybridge Capital's Anthony Scaramucci reportedly went around Davos, making the case to lawmakers and investors that crypto is still a long-term winning technology because it offers a secure transfer of funds. Scaramucci and other crypto cheerleaders' common refrain during the confab was that fraudsters are the problem, not the underlying technology or the lack of regulation around it. There was also clear support of blockchain from tech executives. Microsoft CEO Satya Nadella told Davos attendees that Microsoft supports blockchain technology and that a distributed database has, quote, good use cases. Nadella said Web3, blockchain, and the metaverse are all going to happen, but that, quote, killer apps are needed. Now, separately, IBM Vice Chair Gary Cohn told Yahoo Finance's Brian Sozzi that he thinks blockchain is an evolution on the clearinghouse and will allow instantaneous settlement. He is bullish on blockchain and crypto. Rochelle?
All right, thanks, Jen. At least Bitcoin having a bit of a rally today, above 21,000 at the moment. Thanks so much.
Thanks.
All right, well, crypto's presence in Davos was much diminished this year. Apart from blockchain signage on the promenade, there weren't too many people from the crypto community at the meeting. To get an idea of the landscape for digital assets and blockchain into 2023, Yahoo Finance's Julie Hyman spoke with Circle co-founder and CEO Jeremy Allaire. Take a listen.
Circle's in a really interesting place right now. We have, it's our 10th anniversary actually, and we've been, diligently building out a dollar-based digital currency infrastructure business, and that business has actually thrived over the past several years. It's grown significantly, and it's really right at the kind of cutting edge of the intersection of the traditional financial system, the dollar-based financial system, and this new blockchain-based infrastructure. And so for us, the World Economic Forum convenes policymakers, it convenes major corporations, major financial institutions, thought leaders, and so for us, it's a great platform to help raise awareness of this new innovation in dollars on the internet, and obviously to try and provide our own kind of thought leadership as well. And so it's a very strong investment, and I think we're also, as noted, in a very different place than a lot of firms that have really focused on speculative trading as their core business model. That's never really been our focus. We're more boring and stable and focused on digital dollars.
At the same time, obviously, there's been a ripple effect from the collapse of FTX and what's happened with Sam Bankman-Fried. And not just those that were directly exposed, but that it sort of pulled the curtain back on the fragility in the industry and on the speculation that you're talking about. Have there been any effects for you guys? And what do you think the ultimate effect on the crypto industry is going to be?
Well, there have been some effects. Some of them have actually been quite positive. In the kind of risk-off environment, there's a flight to safety. People are looking to say, where is there actually safe value? And
but aren't they just pulling their money out of crypto entirely?
In some cases, yes. And if you look at sort of price movement, that's a proxy for sort of money coming out. But USDC has actually grown since the FTX collapse, and it's actually, we've seen other digital dollar infrastructure stablecoins have significant declines while we've continued to sustain. And so, I think regulated, transparent, infrastructure like ours is well suited to this environment.
Now, this is not to suggest that this is anywhere in the cards for you, but one of the questions raised by the FTX collapse is where investors stand in the bankruptcy stack, right? People who invested crypto with them. What can you tell us about where that stands at Circle for people who hold USDC?
So USDC is regulated under U.S. payments and electronic money law. There are statutory protections within the states, and USDC is structured as a bankruptcy remote asset. And so individuals can look at the reserves. They can actually see daily positions through an SEC registered and supervised reserve fund that we work with BlackRock on. And so there's deep transparency. And there are very strong protections for individuals that use USDC, just like a balance you might have with PayPal or Venmo or other electronic money providers in the world.
So maybe not backed by the FDIC, so to speak, but is it commensurate with that?
FDIC exists because banks actually don't hold your money on a full reserve basis. They take your money and then they lend it out 8 times over. And so it's FDIC, the insurance exists because the banks actually don't have your money. They've lent it out a bunch of times. And so it's really protection if there was a run on a bank, that there'd be some coverage for people. Electronic money is much more conservative. We are required by law to hold one-for-one reserves, and so that is afforded that kind of protection as well.
One of the things that was in the cards before FTX happened, well, you guys were going to go public through a SPAC. Now you're not going to do that anymore, at least not that SPAC, and at least not right now. What's the plan on that front?
Yeah, so about a year and a half ago, we entered into a transaction to go public through a de-SPAC. That terminated late last year. And, our business has evolved a great deal since 2021. We had a full year of profitability in 2022. We grew over 300%. We have a very strong business right now. And we're kind of taking a beat and really sort of assessing where the public markets are. We're in a position of very solid financial strength, generating cash. And so we don't need to go raise money right now. But we'll obviously keep our eye on the markets. And what I have said is, we are committed to becoming a publicly traded company. We think it's important for transparency and trust for corporations and financial institutions and others that want to do business with us, that they have that kind of full public accountability and visibility.
But you don't feel any urgency to do so, it sounds
No.
like. Okay. Something else you've also talked about in the past is getting a banking charter. Is that still in the cards? Is that something you were interested in pursuing?
Yeah, so we specifically said we wanted to be chartered under federal banking supervision as what we called a full reserve digital currency bank. Now, that doesn't exist in the United States. But what is happening is there's a effort with, I think, sponsorship from the Federal Reserve, the Treasury Department, and in Congress to establish new stablecoin issuing charters, and that's really around new regulations for federal supervision of firms like Circle. We think that's the appropriate kind of supervisory structure at a federal level. What we call it, what that's called in the end, that'll be up to Congress and the ultimate regulators to determine what we're called. But we think that's the right path for the United States. We also think that's the right path for Circle.
There are some regional, or I should say state charters that are going in that direction. Paxos, one of your competitors, has a charter from the New York State, the Department of Financial Services, that sort of ensures funds are never commingled. Is that something you would want to pursue, and why haven't you already?
Well, so we are regulated by many of the, almost every U.S. state and the banking supervisors and financial supervisors. We're not allowed to commingle assets either, so there's really no distinction there. But trust bank charters are limited in scope. I think what the Financial Stability Board and what almost every major national regulator is focused on is really defining stablecoins as a kind of payment system and needing a different level of prudential supervision. And we think that's ultimately what's appropriate. That's what's coming into place in almost every other major jurisdiction. And so I think we're really expecting something like that to emerge in the U.S.
And just to close out, I mean, as we think about where crypto is right now in the wake of FTX, is there more fallout to come? And what is 2023 going to look like?
Well, I look at this, having been in many boom and bust cycles of technology for the past almost 30 years, have seen sort of hype cycles, technology growth cycles, and the troughs of disillusionment, as people say. And my view looking at things right now is there are absolutely going to be more firms that don't survive, whether it's because of risk decisions they've made or just because they can't raise more capital and they can't continue to build. At the same time, though, there are some very solid, durable companies. And I think those companies are going to continue to compound their leadership positions. I think we're one of those, and will really grow significantly.
That was Circle co-founder and CEO Jeremy Allaire, joined by Yahoo Finance's Julie Hyman. All right, well, plenty more ahead on What Just Happened. Our very own Dave Briggs is taking a look at the cost of heading to Davos. Dave.
The enormous cost, Rochelle. If you've got to spare $70,000, you too can be a part of the action next year. That's just the ticket, of course. Then there's food, accommodation, and you got to hit the slopes, right? I'll be straight back with the full breakdown of the extravagant cost. All right, welcome back to What Just Happened. I'm Dave Briggs. I want you to close your eyes and picture Davos. Now, what comes to mind? For most, it's billionaires, CEOs, and world leaders hobnobbing in the Alps, but not for me. It's the $43 hot dog or Caesar salad, just short of $60. If the elevation doesn't take your breath away, the cost of attending WEF will. As Amex says, membership has its privileges, and before you can buy a ticket for 19 grand, you must be a member of the Economic Forum, which costs a mere 52,000. And remember, that's only if you're invited. So now you're out 71K before you even slip into your $1,000 Canada Goose jacket. If you're going to fly 4,000 miles, you gotta go the extra mile to attend private sessions with your peers. And that privilege requires industry associate status, another $137,000 for the week. So unless you're riding solo like Jason Derulo, you want a wingman or woman, which WEF calls industry partner. With the add-on, we're now over $250,000. What about a crew of, say, 5? Strategic partner status sets you back more than $500,000, and we still haven't had a cold drink. Just getting into a party, $200 a head. A hotel, and we're not talking about a real palace here, $500 a night bare minimum, and most VIPs would not dare stay at a Hyman-like hotel. WEF VIPs prefer a private chalet, and for that, $140 grand for the week. Of course, there ain't no subway in Davos, and don't dare ask CEOs to walk. A chauffeur-driven Mercedes for the week, actually a bargain at 10 grand. The mode of transport, though, that truly defines Davos, however, is the private jet. Oh, it's a nice one. More than 1,000 of those flew into the environmentally focused conference this week. And if you don't own your own jet, NetJets sets you back $70,000 round trip. But despite these eye-popping numbers, what you're hearing from execs from all industries is, well, they're packing in 6 months to a year worth of face-to-face meetings in one trip and will happily fork over the cash this time next year, Rochelle.
I mean, it's just mind-boggling. It's never in a million years or $1 million am I paying that much money, for sure. Now, Dave, we know that Microsoft is coming under fire for hosting a Sting concert in Davos. What's the latest there?
Yeah, Satya Nadella really came under a lot of heat for that private Sting performance in front of just 50 people, with the Columbia professor and author Rita McGrath saying, "I'm a big fan of Satya Nadella, but this is seriously bad executive symbolism." And while on the surface I agree, I'm a bit of an expert in being laid off, Rochelle. And I think for those 10,000 employees who got 6 months of severance, they've got to separate. Satya Nadella has a duty to make those employees feel wanted, feel rewarded, continue to build morale, and make people believe that this company is going to be fine moving forward. In fact, there's probably another round of layoffs coming for Microsoft. So sometimes you just have to keep morale in its place, spend that money, and take a bit of a PR hit. Fields of gold truly was what they were walking through in Davos as Sting performed, Rochelle.
Nice play there. And I do love Sting, but yes, the optics definitely not good. A big thank you there to our very own Dave Briggs.
Thanks.
All right, coming up next on What Just Happened, years on from that famous speech at the UN, Greta Thunberg still making waves. We look at her comments in Davos and take a temperature check on the climate movement today. That's all up next. Well, before we go, let's do a final check of the market action as we head into the noon hour. We see all three major indices in positive territory, though off their session highs. We see the Dow there up about 93 points, the S&P 500 there up 32 points, the Nasdaq up the most though, about 1.4%, driven up by Google, Netflix and Tesla, pushing those up thanks to Alphabet's layoffs, strong results from Netflix and large investors pouring into Tesla ahead of earnings. That'll do it for this week's What Just Happened. I'm Rochelle Akufo. I will see you Monday at 11 a.m. Eastern.